found on all the previous recording. I'm sharing the link right now. I'm putting this in the chat box. Watch. Let me try to post. Posted it in the chat box. And if you are also part of this meetup group, you can see that's where I grabbed the information from. So without wasting time, so that those who watch the recording will not be bored. Last week we did like, this is actually the part 2 of last week. Let me show us what we had last week. Last week. Yes, this is last week. So last week we did ordinary shares, preference shares, dividend, and retained earning. And I told us that the title was so long because my biggest fear is not, whether I'm able to finish what I've planned, but boring you like, 30 minutes into the session and then I say I'm done, and you budgeted 1 hour for the session. It's better I give you more than we can take than to try to trim things down. So as God will have it, we did all of these up to here. I'm not sure I talked about dividends. So today is like part 2, where we are going to do the actual modeling. So we're going to be modeling in Excel what we talked about. So when you give someone, when you raise equity, maybe as the actual founding owners, or as other series, how do you plug them into Excel and create a model? And then dividends too, how do you model them? And automatically we just do retained earnings straight up from there. So the practice file that I'm going to use, because today will be more of a practical, is this. So maybe when I'm done, I will take out what's not important and just share with us the actual parts that we use. But again, so that you have a clear idea of what it is that we are doing. I hope there is no background noise. I have a fan directly facing my computer, so I don't know. If you think the background is a bit noisy, you can let me know. If you let me know, I can maybe turn it away or do something. But if you think the volume and all is clear and no crackling sound or some distracting sound underneath, then good, we carry on. Just let me know. So here is what we are going to work on. This is a company that the model is complete. So that's why I wanted to start with, instead of deleting ahead of class, let me even start to show you, when you have a complete company and everything is there, how does it really look like? So again, this is my own approach that I use for jobs. Overnight, I was working on a client's job till around 7 a.m. I didn't sleep. It reminded me of going to Vigil, or those days when we used to do night browsing, where internet was something you go to a cyber cafe, and night browsing is cheaper, so you pay for night. That was the feeling I had. But so this is how it normally is. There will be breakdown of all that the company is into. So if this is your company, so this company is into manufacturing face mask, hand sanitizer, test tube, syringes, right? And then we're going to write, okay, what are the plans, the structure? We're going to make so units at so price to sell, at so cost of production. We're going to make, like that. And then our overhead expenses, our general and admin expenses, a breakdown of them. You see all of these marketing expenses, if you're going to incur some research and development costs, great. We also include them. If you take loan, tax, obviously. If you take loan, the conditions attached to the loan, how you're going to repay. It normally leaves space for multiple loans in templates that I'm creating for clients or training. Because as a company, you might have just one loan and tomorrow you decide to take an extra loan. So it makes it easy for you to just plug them in. And then if you have bank overdraft facility, if you decide to put your money, your excess cash in an interest-bearing account, but this is where we are coming to today. So this is the area of focus today. If you raise equity, let me use a lighter color. So if you raise equity, how do we capture that? So that's what we are going to work on today. Let me freeze pane so that it's easy for us to follow along. Freeze. If you have any question, remember, this is a wee kind of, by now, you guys should even feel more comfortable with me than people you meet in a physical training, because we've been meeting almost every week across many days. So everything is equal.
Hello.
Yes, sir. Yes.
Kindly share this template with us. You can even share it with us now, so that.
My plan is to share it now because there are some modifications I'm going to make to it.
Okay, sir. We'll be expecting the link.
Okay. So this is where what we want to model. This is where the plan is going to come from. I'm going to delete everything here so that we can totally explain how it works. Let me zoom my screen. More good. Okay, so last week, last week we talked about this. This one is just advertisements. If you're interested in our training, we have this training coming up this month and next month. Okay, Excel, financial modeling, Power BI, big data, and you can do one-on-one class if you want. So we have what we call personalized for me, where you pick what you want, and that's what we're going to teach you on a one-on-one class. Okay, so this is the one this is what we are doing today, the actual modeling. But last week we talked through all of this, right? Ordinary shares, preference shares. So I'm not going to repeat it. If you missed out on last week, go and watch the recording. Now you can see this is where we're going to put all those things. Let me just write this as ordinary shares. Ordinary shares. So ordinary share, preference shares. And then there are two information that, let me say three actually. Three. I like to put two together on one line because it's a lot easier that way. Should I separate them out? Let me separate them out for the purpose of this training. I'm going to separate them out. So at least it will be a lot more obvious to you that there are three. So there are three components to every of those equity type. So let me even delete everything. So let me make this color fainter so that it will be easy for you to see. I just want you to know that that's where ordinary shares. So when you issue new shares. So when you are starting a company, you will definitely issue shares, right? Because that's the whole process of incorporation. How many shares have you guys authorized the business to start with? How much are you pumping in at the start? So yes, there's going to be that, and it will be, we're in Nigeria, so it will be in Naira. So if you start a business, let's see when this business is starting. So this company is actually started Corona period now, so started last year. So obviously they decided to start the business with 100 million naira, 100 million naira. This is where I'm going to put it. That yes, we did a share issuance, ordinary share issuance of 100 million naira. Okay. Now let's carry on. When you issue shares, at some point, especially if the people who are part of the company, the people putting money to start the company, if they are not going to be actively working in the company, which means they are not going to be collecting salary, maybe the max they will collect is if you pay your board of directors, and those are sitting allowance. So obviously that is nothing special. Even if you have an independent member in an independent director in your board, you're going to pay the person that. So there is nothing special to that. There is nothing that is going to sound extraordinary to your co-investors if that's all they are going to get. So at some point, we need to let them know that we are committing to give an ordinary share dividend. So it's a mouthful, but there's a reason why I want to write it in full so that you thoroughly understand it. So ordinary share dividend payout rates. What is a percentage anyway? So what does this mean? We understand what ordinary share dividend means. The only thing that is like an extra new word here is payout rates. So are we committing to pay half of our profit as dividend? Are we committing to pay, 30% of our profit as dividend? So I was working, we have this business, Nigerian market data. By the way, this is the stuff I was saying, the personalized form. Yeah, we have this business, Nigerian market data, and what we sell is market data. That's why it's called Nigerian market data. So last week, someone bought a research on Zenith Bank. So the ultimate user, so the husband, I think, bought for the wife. The wife is studying in the US, and I don't know more than that anyway. So they bought this one, Zenith Bank. I had to update it because if you see it's up until 2018. This is up until 2018, right? So I had to update it. Let me show you what it looks like. Control open. Zenith Bank. I want to show you what I mean by when a company signal. Sometimes it can be a signal, sometimes it can be a commitment that we're going to pay a portion of a kind of fixed ratio of our profits or as dividend. Market data, NMD analysis, good. Zenith Bank. So this is it. So this is part of the package we sent to the person. We sent the entire, how many years? I think we sent the person about 11 years annual report, and then we did the analysis too. This should be, yes, it's 11 years. So we did the analysis too of the entire financial statement, income statement for Zenith Bank, balance sheet, historical cash flow. Now this is what I want to show you. Let's go to dividend. This is dividend, right? If I zoom my screen, you will see that there's a pattern. The dividend keeps growing year on year. It was only on one particular year that they paid the same dividend. And the reason was, what was it? I can't even remember it because it was a really weird one. Oh, they paid I can't remember, so I don't say what is wrong anyway. But the key thing I want to bring out is, if you look at this dividend that Zenith Bank paid, and if you look at the profit that Zenith Bank has been making, they are usually tied together. It is usually growing in tandem. If I do the percentage, you will see that it oscillates around a particular range. So everybody kinds of expects, everybody is the general speak anyway, Everybody expects that if I buy Zenith Bank, if I buy GT Bank, they normally pay X percentage of their profit as dividend, right? So that's what we call signaling. That's why pension funds buy them. That's why people who know that Nigerian market is very funny, stocks might not go up, but we all know we collect dividends, right? So that's why they might also want to buy into companies like Zenith Bank, GT Bank, and companies that consistently pay dividend, right? So you too, as a business owner, when you are getting investors, at some point, yes, it makes sense that at the beginning it might not be useful to give them dividend because it's better to pump the money back into the business, right? But then at some point, you have to let them know that we are going to be paying dividend because that's the only way they will get back their money. And you are founder and you're working in the company, you are already collecting salary, right? So it's not like something is not coming to you. The bigger the company is, the bigger your salary. So ultimately, you are benefiting one way. Anyway, end of story. I'm going to say maybe for the first 3 years, we are not going to pay any dividend. We want to use that to scale the business. So we are saying 0% dividend payout rate. Okay, I said something and I didn't do the stuff. See, I'm going to move this down. Before the dividend payout rate, you can also do buyback, ordinary share buyback. What does buyback mean? An investor is not happy, he wants to leave. It happens a lot at the start of a business. You know, all of you cannot easily be on the same page, especially when you have multiple founders. Someone can just leave to start something else, and you people feel you just want to buy out his shares anyway, anyhow you guys arrange it. So when you do buybacks, so let's say maybe that happened here. We bought back someone's part of one of us shareholding. So buyback is from the perspective of the company itself. What do I mean from the perspective? From the perspective of CK Healthcare. Because you can swap out, you guys can decide, if there are 4 of you that started a business, one person is no longer happy or there's friction, and you guys just want to part way amicably, and that one person's portion of the shares is 200, in this case, maybe 20,000, 20 million, let's say 20 million, right? 20 million. The other 3 of you can decide to absorb his own. So in that case, there is no buyback because as far as the company is concerned, you still have 100 million share capital, right? But what you guys decide to do is let the company buy it and just dissolve it. So you can buy it and keep it as treasury that you can issue to employees or somebody else that you get to replace him, or you can buy it and just completely destroy it. But the key thing is that if you buy it and you completely destroy it, then it has to go off here as share buyback. Okay, so that's why in US, they say when you buy shares of Apple, buy shares of Microsoft, buy shares of companies that consistently do buyback, your share value automatically grows, even if the share price did not increase. Why? The amount of shares in circulation is reduced. So when there's dividend, you naturally get more. If your percentage of ownership was 2%, last year, but because they did buyback, it can rise to 3% after they do buyback. Okay, so that's how this is captured on the books. And then the one I was saying, the share dividend payout rate. So I said we should do 0% for the first 3 years, and then we can signal, or we can, at least in the model, commit to saying we're going to give 30% of the profit as bonus, as dividend. As dividend is the right word anyway, but sometimes people, if you are the single manager of a business, you can say bonus, you can say director's bonus. I've seen different people capture it in different terms when I model for clients outside this country. the owner of the company, I'm doing a model for him. He says at the end of the year, he takes a bonus from the profit. That bonus now, we have to agree, is this bonus going to be dividend? So that in my own model, you might call it bonus, but if it's going to come as dividend, then great. That is better for you because you won't pay pay tax, you won't pay income tax on it. You pay what you pay will just be the normal. In Nigeria, we pay withholding, and I think withholding tax it used to be 10% they take for shares, and that might be better for you than you just adding it as salary as expense to the company, and then you get taxed fully on it. Anyway, that's that part. Now, all what I've written now, I'm going to redo them for the preference shares. Preference share issuance. We already explained last week what preference shares mean. So, and I told us that usually companies, external people joining you afterwards, you are the founding investors. People who will join you afterwards, especially angel investor, venture capital, they have a preference for preference shares. Then we discussed it last week anyway. You can go watch the recording. So let's say you raise some funding of 250 million naira at this year, but it came in as preference. So the thing with preference is preference. Let me also do the buyback in case there is a buyback. There can be a buyback too for preference. There have been cases where when a company wants to raise, you want to raise an additional fund, right? So the reason sometimes that you're raising an additional fund is because some people want to exit. So some part of that exit might involve raising new shares and destroying some anyway. Maybe instead of raising the new shares as preference, we want to let these additional guys come in as ordinary shares. So you might have to destroy some preference shares, so do like a buyback. So it happens both ways anyway. So I'm going to just, I'm not going to put anyone here, since once you understand the concept from this one, it's, wait, okay, let's put something at least for the sake of practice. It's not very common, but anyhow. So maybe we did a 50 million share buyback. Then there is preference share. One is now called dividend yield. Okay, so preference shares dividend yield. So it's called a yield because it has this concept of a bond yield, coupon yield, a fixed income kind of payout. All right. So a lot of times it comes with a very, unlike ordinary shares that you can be unsure of what to commit to. In preference shares, it's part of the difficult discussion you need to have at the start. So you can say this will come at, I don't know, maybe 10% dividends yield. What it means is every year you're going to be paying the dividend shareholders 10% of their original investment as profit, depending on, again, the structure of the preference share. Is it a non-cumulative? Is it a guaranteed? Is it, we all talked about this last week. So if you missed last week or you didn't pay attention, just go and watch the video. So that's this part. Any question before I move now to how we are going to capture the inner workings of all of these things? So we're going to capture it here in equity sheet. Okay. So, but before I go to that portion of my file, so let me color that sheet differently too, so that it will be easy for you when I give us this. So I'm going to color it green so that it stands out, so you will know the sheets that we worked on. So any question at this point from anybody? Are we clear? Should I carry on? You totally understand this breakdown, or you want to take one last look at it before I move to the next part of it? So this is like the input part, where you are signaling, you are inputting what the plan is or what is expected, right? And that's, in my model, I always color them differently. I use this, I don't know what they call it, maybe amber or orange. I use this color, so it makes it easier for me to tell my end user, the client, that Please don't touch any other sheets. Don't change the formulas or type anything into any of these other sheets. Only the orange sheets you should change. You should type in stuff. So obviously, this is the equity part of the inputs. So I'm going on then, since nobody's asking any question and it seems you're all catching on like a...
Sorry.
Hi,
Hi, Michael. Good afternoon,
yes,
sir.
yes, sir.
Yeah. Yeah. So sorry, I joined in late. So I'm gonna watch this video again. But I want to ask, last week's video, where can one find it, please?
Okay, so if you you might not see the chat box. I'm going to reshare it because someone also asked and then I shared. So I'll just reshare it in case you are not seeing it yet in the chat box. So great, someone has helped me. Thanks, Tife. Yes.
All right, thanks a lot.
You're welcome. Just to recap, this is what we did. We broke down all the things you need to capture about equity raise, the conditions attached, the money you borrowed, if you need to buy out some people, like what we call the share buyback, whatever dividend you are committing to pay, similar for preference shares. So now we have a sheet called equity schedule. That's what I call mine. People have different names. In my own modeling, because my work is usually done for the users of my model are normally the company owners, the business owners, the idea originator, or the person who is driving the business. So they are seldom finance guys, and financial modeling comes scary to them already. So I like to split things out such that, in fact, I have some sheets that the things you will find on them are very little. You'll be wondering, why is Michael putting just something like this in an entire sheet? You know, it's not for me, because for me, I can put everything in one sheet and that might even be faster and easier. It's for the user. It's for the person who is going to use it, the company is going to use it. So it makes it easier for them to understand what I've done, for them to know what to change, for them to understand that everything is, I call it modular. So that's my own approach. Back to this. This is where I do my own breakdown, where we share premium B. Okay, so in these model inputs, this one that I've put here is a combination of the share capital and premium. That's how I normally capture it, because not everybody understands the difference. And when I separate them, they are absolutely confused. I can show you an example of even companies too who they do that in their financial statements. Let me pull out some for us. So at least those who maybe didn't get the question, they might even be able to understand where the question, what the question is saying. So I'm going to open Zenith Bank splits there. So let's see one that splits. Bring this into screen. So Zenith Bank splits theirs. Let me bring that here. The share capital is split from the premium. Then I will look for a company that does not split. Good. Can you see what I'm saying? If I control, how do I? If you can look at my screen, you will notice this part. This is Zenith Bank financial statement. Can you see they split it? The share capital separate from the share premium. Maybe I should even go to the note so that people can even better understand what this stands for. Note 34, 35. But in my modeling, I have them bundled together. Note 34, 35. pass the notes like this. Notes. Okay, I don't think yeah, passed it. Before should be around here. Good. You see. I think that was the day we did this. I can't remember which session we did it, but not a problem to re-explain. Whenever I can't show you my company's incorporation document, as if this was I don't know if I know you all, and if maybe this was a one-on-one, I could have shown you what it's like when you incorporate a company in Nigeria, at least for a private company, even public too, is similar, it's the same, it's just the document can be different. Or I will have shown you what it is like for a private limited liability company. You will always, in Nigeria, we always, I don't know, someone who knows better than me can say, but I know I've not seen shares of another kobo. It's always 50 kobo. So our authorized shares are always at 50 kobo each. So Zenith Bank has 40 billion ordinary shares, which are authorized shares. 40 billion authorized shares of 50 kobo each. So you know when you multiply 40 billion by 50 kobo, it's going to come to 20 billion. Okay, good. Now, but they even have two things. They did not issue everything. Okay, so everything is not issued, but forget about that part. The key thing I want you to know is, let's go to the premium. Now, when you are selling your shares, you're not going to sell it at 50 kobo. If you go, when you want to buy Zenith Bank shares, I want you to tell me, is it 50 kobo you are buying it at? Let's go and check online now. What is it? It's selling for 20 something naira. Zenith Bank share. See? So can you see my screen? Selling for 24 naira 30 kobo. So what it means is everybody who bought into, well, if you buy into Zenith Bank right now, you're going to be paying 20 what again? 24 naira 30 kobo for this 50 kobo share. So the share capital will not change, but the share premium captures that differential in how much. So now the thing is, it's captured on the primary listing, not on the secondary listing. So that's why this does not change as much as the share price change. That's another thing we'll talk about another time. But the key thing is when if Zenith Bank does a PO, public offer, you will notice that they will not do a public offer at 50 kobo per share. They will do it at something significantly higher. So the difference, the thing above that 50 kobo is the share premium. What you pay, the premium you are paying above the authorized share price. Let me use that word. So that's it. And again, most people don't care about that dichotomy, especially when I'm dealing with people who they understand that they even know that it doesn't make sense for them to sell their shares at 50 kobo. So they understand the part that yes, we are supposed to sell it at even an increasing value. When you buy last year and some people want to invest in next year, they should pay more than the people that invested in per share, last year. So everybody knows that. So I normally just don't even bother splitting it that way. I just put everything together. And let me see if I can find a company's financial statement that also does not even bother to split it like that, and they just have everything bundled together too. Let's just check. If I see one, great. If I don't see on time, we move on. Let me try Nigerian bureaus. Come on, time. Okay. And if I don't finish today and then I'm not doing part 3 again. This is not cash flow, financial position. These people to have their split. Let me just open one more and see. Let's try MTN. Honestly. Leslie, 2 hours, yeah, split. Okay, so I give up. Let's just move on. But you got the explanation I gave there. I know I've seen companies on their financial statement to have it lumped together. Okay, so thanks for the question. It was, at least it brought in a bit more diversity to the training. I'm going to move now here, and what should I do? Should I delete everything? Should I? Let me look at my time. Okay. I'm going to okay, let me delete everything. Please, I will delete in such a way that it will be easy for me to type back without. So yeah, so let me delete like that. All right, so for ordinary shares, I think we have even modified our own, right? So in fact, let me just delete everything. So yeah, faster, then I'll just cut down on my stories. So going to can't see myself. Let me just put my picture on the screen. Okay, good. Ordinary shares. We did what? We have issuance, buyback, issuance, buyback. Issuance, buyback. And then I'm going to do opening and closing. So closing value. Again, the way I'm writing it might not match with the way it was before because I've deleted where it was, but those ones are semantics. It's the same content that I'll be generating. Let me bring back my grid lines so that it becomes easier for me to soon. Okay, good. Opening is always equals to last year closing, but what we will bring in first is what are the issuance? What did we say we are issuing? It will come from here, right? So what did we issue? We didn't issue anything in 2016, but if I drag it, it will pull for the future year. So you see where we issued something, it came, right? Then what about buyback? Did we do any buyback? Yes. So there was a particular year that we did buyback. So this one is going to capture that. Then now the closing value is always equal to the summation of the opening value plus the share issuance plus the share buyback. Buyback is already in minus, so that's why I'm doing plus. Okay. So that one too I drag. Then next year's opening value is equals to last year's closing value. That's one nice thing about balance sheet items, and I think equity items too. Next year's value, opening value is always equals to last year's opening value. So I do that. I drag, and we are done. So it's a bit straightforward, you know, but it's useful because we're going to need it. So I'm going to do exactly the same for the preference shares. Now, this is the modeling that I'm talking about. This is how you are capturing these changes. If tomorrow the person feels, oh, we couldn't raise the money on time, there was a delay, So instead of it coming this year, it came in 2021. And then this buyback is now happening, a year after. Or even the buyback, it was now a 10 million naira or something, As long as the person is changing it here, those changes will flow here automatically. Can you see they flowed here automatically? Okay, so that's why it's called a model, kind of. I'm going to do the same. In fact, let me just copy everything as I have here and paste here. Then control, find and replace, like ordinary should be preference now. So instead of ordinary, it should carry preference. So now it's faster for me than typing it twice. So we're going to just do the same thing. Start with issuance. Issuance is equal to issuance of issuance. And I can just drag down to do for buyback. I can do the formula straight up of summation of opening plus issuance plus buyback that is already in minus. Give me the closing value. And I'm going to drag this 1 year forward. Then take the opportunity to do that. Opening next year is equal to closing of this year. Then now that I have everything computed, drag this all into the future. Okay, great. So that part is done. Then next is how are these going to impact our dividend? So that's if you remember in the title of what we are doing today, we are modeling equity raise, which is now done. What about dividend and retain earnings? So we want to do the dividend portion now. So dividends. So there are two kinds of dividends that are going to happen based on this our equity raise. There is the dividend that will come to the ordinary shares. There's a dividend that will come to the preference shares, guys. So let's start. Where is dividend going to come from? It's going to come from the profit that we have made. So I need to say what profit have we made? Net income. So what profit have we made? So from there is where we will now compute the preference, because preference, guys, that's why it's called preference. They come first. You pay them first before you pay ordinary. So preference shares dividend yield. That is the foundational thing to calculate the dividend that will go to the preference, guys. So with that, we're able to compute the preference shares dividend. Let me just. After that, we will now have the net income that will be to ordinary shareholders, because it is the remainder of the money that is now available to share to ordinary shares, guy. Okay, so similarly too, we are going to say what is the ordinary shares dividend payout rate. Okay, and with that bit of information, we can now compute what is the ordinary shares dividend. And with that now, we can do retain earning, but let's stop here for now. So let's do this one. All right, then we'll do retain earning maybe as a separate section. So let's finish this one. One thing I like to do in my model is I like to put the currency stuff, because I typically do stuff for companies that have business in more than one countries. So if you do, I do a model for one subsidiary, another for that. It can be confusing if the currency is not there. They won't know, is this one in Ghanaian cedis, is this or is it in Naira? Because yes, I could decide to do for all the individual country, but use one currency, or decide to use the local currency. But anyway, for transparency or lack of ambiguity in my work, I always put the currency in the model on every sheet. So net income will be, in fact, this one, almost everything will be NGN. Only two things will be percentage. This dividend yield here and this dividend payout will be percentage. So with that part done, where are we going to get the net income from? It's going to come from the income statement. If I go here and I grab the income statement, in net income from income statement, so I've done that right now. See, net income statement. I grab that. Should not come as percentage, so I can fix that to 0. Then I just drag this so that at least you see whether you grab the right thing. Okay, looks like I grabbed the right thing. Then the dividend yield, that's going to come from here. Preference one first. Preference first. This is, geez, I've mixed these things up. This should be percentage, it should be NGN. Yeah. So this should be percentage. So I'm going to drag this all the way to the end. That looks okay. Then the dividend yield. So I want to ask you a question. We did this last week, but I want to know whether you remember or you already know it anyway. When I'm computing, so let's take for here now, right? Where we say we are paying them 10%, and I want to compute the actual money. So now this 10%, am I going to say 10%, is it of profits or of the money that they put into the business? What do you think? Anybody? Is it 10% of the profit we made that year or 10% of the original money these guys invested in the business? Anyone? Okay, Mr. Olufade says profits. Okay, anybody else?
10% of the money invested in the business.
Okay, Mr. Bolaji says 10% of the original money they invested. Mr. Sadiq, I see your hand is up. Yes. Yes, say yours.
10%, if it is a preference share, it will
Yes.
be 10% of what they invested. But if
Okay.
it's a common share, it is going to be 10% of the net income, profit after tax.
Okay, so we're having more people on the side of money they invested. Mr. Tunde, I see your answer. You say have invested. Okay, so let's go check it out. Reference, dividend, calculation. Let me see. Let me look for something that, or maybe they will explain it in very easy to follow English. This is how I used to use. When I type in search, I open like almost every answer that comes. If I go to one answer and the person is using forever to get to the point, just move to the other one. This is how I normally do my own. Sometimes I skip the first one, which is funny. Let me open this one too. Let's see. Okay. These guys have decided to put in something extra that I don't want. So I'm going to leave this guy's answer. Let's go and see. Let's leave this guys too. Everyone understand what these are trying to say. This is closer in the grammar to what I prefer something that is a formula so that we see it together. Okay. Anyway, let's use this one. At least this one limited it to 2 formulas. I didn't want those guys that were using 3 formulas because it makes it more difficult for me to now start explaining. You know, like these people now 3 formulas, you know. So let's just stick to this guy that we have seen that is using 2. So the only thing is they said par value, which is another word for what is our right answer. So the dividend rate times the par value. The par value is the original money invested. If I go to the ordinary shares one, instead of par value, they will put the profits. So since this is not profit here, then you see that it's obviously the money that was originally invested. So that's one part of the modeling that sometimes when I proofread people's work, you know, well, I used to make the mistake where if you had gone through my Udemy course, you probably would have seen that mistake. In my first recording, I made a mistake and I had to go and correct it. It was a very embarrassing mistake because correcting it was not easy. You know, when you have recorded video, you now have to there was not a mistake in the middle. Very annoying. You'll be like, how did I not cross-check and fix it before recording it? So anyway, it is majority of us are correct. It's actually tied to the par value, the original money invested. So I'm going to do the calculation now, but I'm going to do it from, well, let me do it from here that has value anyway. So the dividend yield you are committing to times the par value. So the par value is the closing value anyway. Closing value. That's one. And I'm going to drag it here. And because we are creating a model, we have to bring it, even though we know there are no values for the past, things can change. If our user decides to raise money early on, then if you didn't drag it, then your model will not be correct anymore. So just drag it to everywhere. So with that, we will now have the money that will be left for ordinary shares, which is what originally was profit minus what you took out from it to pay the preference shares guys. Okay. Later on, we can, depending on the time we have, we can capture. Kenya, if you are following very well, I can capture some funny things that you might need to capture in your own too. So with that part done, we can go and bring in. So this will be the money that is available for ordinary shareholders to participate in, to have. Then we can now talk about the percentage you want to pay the which guys now, the ordinary guys. So if I go here, ordinary share dividend payout rate. Good, it's going to be in percentage. So I make it in percentage and I drag all the way to the right, to the end. So from here, this one is on the profit anyway. This times, so I'm going to show you a problem that you need to factor in ahead. And there's a very easy way to factor it. I already did it in one of our past sessions. So now I want to ask you, assuming we add the commitment here of 20%, now it makes it looks as if you are going to pay negative dividend. This is not possible, right? You don't pay negative dividend. So we need to do our formula in such a way that, yes, we have committed to paying dividend, or we are in principle allowing to pay dividend of 20% of profit. But if we make a loss, then we can't pay dividend. The same thing too for tax. If you make a loss, then ordinarily you won't pay tax. Well, you pay minimum tax anyway. But technically you won't pay tax. Okay. So the formula that we use, you probably need to go and watch the video that I did on the session we had on, let me see if I can pull it out, YouTube. I did it like that was the main thing I focused on, how you cap things. Mean, max are the formulas, but then how do you cap things in such a way that, I think we did it in financial modeling. So even me, I'm getting lost in I think this is its office hour. Yes, I think it's this one. And I want to see everything. So the one where we did something around.
Okay. Kindly give us the link of this also.
Yeah, okay, of this. Let me throw that there. So the financial modeling playlist. So that day we did project finance, I think, and more cash sweep. This one, yes, cash sweep. So this one has it. It shows you how you setting all these. It cannot be above, it cannot be above, it cannot be below, capping and flooring. So to understand how to cap calculations, you know, like a mean and max cap. So this session will help you with that one. Good. Let me quickly round up, complete what we are doing. So in that session, I told us that mean, max. Now, what do you think about if you want to set up a upper limit? If you want to set up a lower limit? You know, or upper cap, lower cap. So let me ask you, if you want to set up a upper cap, an upper cap, what will you use? Mean or max? Just tell me what comes to your mind. What's the thing that comes to you? Are you going to max it at that value or mean it at that value? What comes to your mind?
Max.
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 Perfect. Because you think about it, maximum, right? So this is it. Just swap it. You see the way I've swapped it. Whatever comes to your mind, swap it. That's the easiest way. Because it happens to me, it still happened to me this past week. I used the wrong formula because I was overthinking it. Just think about what comes to your mind if I want to set the upper limit. Max, Abi, then use the opposite, which is mean. So in this case, we want to set a lower limit, which means we must not pay less than 0. You cannot pay negative dividend. So lower limit, what comes to my mind is mean. Minimum now, I swap it. So swapping it means I use max. So that's what I'm going to do. I will say max of whatever my calculation is, then the floor, that limit is 0. We cannot pay less than 0. So I'm flooring it. And that's what I will do. You know, again, it sounds funny, but if you watch that video, I took my time to explain it, and it works. You know, so that's one. Now that part is done. We can now talk about the retained earning. So retained earning too as opening, as net income, then the dividends you are paying. But now, because the dividend is an outflow, you are paying it out of your income. So I like to just make my life easy and put it in brackets as to show that it's coming as a negative, you know, so that my calculations become a lot easier. Preference shares dividend. Then what's the other one? Ordinary shares dividend. Ordinary shares dividend. I'll share this. So wait to the end. I will share this file. I will take out what is not useful or something and share. Some of this will break, so you have to be careful because some of this will have broken because of what I've done here. So just focus on the things I colored. What's next? So yes, what will be next is now closing value. You know, closing value of our retained earnings. Closing value or retained earnings. Let me even call it that way so that it's easy for you to closing value of retained earnings. As usual, I put Naira, so everybody knows it's in Naira. So let's start. Net income, not difficult. We already have it here. And preference share is just to put a minus and link to the dividend we pay here. Ordinary shares, put a minus and link to where we paid here. Then the total value will now be the summation of the opening plus the net income plus the preference dividend plus because the preference dividend and the ordinary dividend are already in minus, so that's why I can plus them this way. Remember, opening next year is equal to closing last year. Then I can just repeat all these formulas. Then this one that has everything, I drag. Voila. So I have my retained earnings. So this is the end of it. If you ask me, this is the end. Okay. So we have modeled our retained earning, which maybe in another session we might talk about how you use this to all what we have here to go and populate these ones will populate what now? They will populate balance sheet and cash flow. Yeah. So the dividend you pay will go to cash flow. Retained earning will go to balance sheet. I think that's it anyway. And issuance will go to cash flow. Issuance and buyback too. Issuance and buyback. So maybe in another session when we do something like that, we'll see how this fits into those parts. So this particular schedule fits into two financial statements, the balance sheet and the cash flow. So thank you very, very much. Let me upload this for us. Remember, some things will have broken in the front, so please just pay attention to the thing we did, equity and model input, the things I colored green. Don't go and give yourself a headache on other things because these are the things we focused on. So I'm going to close this file, save it, go to the thing I use for uploading my and if you have any question, you can also ask while I'm trying to upload. And if you have any suggestions, we are looking for sponsors. Before we are looking for speakers, we are still looking for speakers, but now we are also looking for sponsors. So
yeah, Mr. Michael.
Yes, sir.
Hello, can you hear me? If
Very
a company, let's say an investment company now.
Yes, sir.
They are doing very
I'm not hearing again.
very badly.
You said they are doing what? I didn't catch the they are doing.
They are, in short, they are detect and
Breaking seriously. Mr. Frank, the Excel session is going to be at 4 o'clock. Yeah, every week, yes. Today we have to. Mr. Bola, your voice is breaking. I don't know, maybe it's network or something. Like I am struggling to hear only the first sentence I think I heard. Every other thing I could not make it out. Okay, so I'm uploading and in about some seconds it should be done. I can give us the, okay, it's done. I can also give us the link for the Excel too. So the practice file, I'm pasting the practice file. Practice file is, voila. If you are interested in the Excel session that will be coming up by 4 p.m., which is less than an hour from now, my colleague Temidayo is the one cooking some things for us. It's going to blow your mind today. So Excel. Any other question before I close the session?
Yeah, hello, Mr. Michael.
Now it's
assuming an investment company is doing very badly financially, whereas they need a rating agency. So what can they do creatively to the financials to ensure that the rating agency will rate them A, despite what can they do to their financials as a creative wise to ensure that they get well rated by the rating agency, being an investment company, for instance, or any company for that matter?
Okay, that's a very interesting one. So I will tell you from the little interactions I've had with the rating agencies. I've done trainings for credit risk rating agencies in Nigeria, and I read about the ones do all these foreign ones do how they do their rating. So there are different, every rating agency, they always publish their methodology. So like Moody's now, we tell you Moody's, S&P, which are all those foreign ones. They tell you how they do theirs. There's GCR in Nigeria. There's can't remember some other ones. There is Augusto. I spelled it correctly. There are a few other ones too in Nigeria that I can't remember the other names. So now what I know is they always publish their, and there's Fitch also too. They always publish their methodology. So that's one thing they do, which makes it easy for anybody to game. It might not still be easy because they make their methodology very robust that even if you want to game it, is except you lie in your financial statement, which you and your auditors will be in problems. So auditors are supposed to not let you lie. But then now let's say that a rating agency has said for them what they are using. All of them, one thing I know they always use your debt ratio, debt to equity ratio. They check it. If it's not healthy, they might tell you what is healthy. They might tell you what, if you fall below, why they will rate you AAA, and when you break something, why they will rate you, maybe A minus and blah blah. So they always publish it. Then debt to equity ratio, also where your profitability too. Obviously, if you're not making profit, I don't think they will want to rate you very high. They pick some things that track your cash flow. So they check also your debt service ratio, something like a times interest end. How many times your income before EBIT, your earning before interest and tax can cover your interest. So blah blah, you get the whole thing. They usually itemize. If I once read through Wazim feature S&P, and I was tired because the document was so long. I'm like, just to read, there's all these many things. So that's how thorough they usually should be, or her. So now, if I know the one I'm interested in, if I'm interested in getting AAA from Agosto, then I will go and read what their own stuffs are. Then if I know that I might not get it because I'm struggling, then instead of me trying to kill all the fires, I will just focus on the fires that will make me get the AAA, right? So maybe out of 10 things that are not going right, maybe it might be 5 things that they are going to consider. Then I might, because I want the AAA, I don't know whatever reason why that might be super important, but like, let's just take your question face value. Then as management, you go and fix those ones, or you try and make those ones look good, and then, you will get it. So that's what I know people do. I don't know if someone else has. I have our guys in the house too. If they have any opinions, anything to share on top. But that's the answer that
Yes, I love the way you answered it. It was perfect. Thank you.
Thank you too. So at this juncture, I'm going to end the session. Thank you very, very much. And if you're interested in the Excel, it would be nice to have you join us again for that. And so bye-bye and see you next week. We are looking for sponsors. We are looking for speakers. Mr. Olufade, Mr. Sadiq, Mr. Alex, Mr. Anthony, Mr. Everybody, please come and present to us anything. That's the thing. You don't have to pick a complex topic.
Please, can you share the link? Please, can you share the link of this template again? I was off. I was out when you shared it.
Yeah, I'll share it again.
Thank you.
So please, the presentation, even if it is your inspiring journey, how you rose in your career in finance, that's enough. If you just come and tell us story, people will find it valuable too. So it's not like you have to now go and then start doing 3 months as if you want to write a book, And yeah, if you do something robust too, I'm just saying that don't think of something so big that you forever don't want to come and present. So thank you very, very much. Just for speakers, for speaker volunteer, just email us at webinar@UrBizEdge.com or WhatsApp me 080631252226. I'm putting this in the chat box, and we can easily just take it away from there. So thank you very much. Happy Sunday. Bye-bye. See you next week. Okay. I was afraid. I thought I didn't turn on recording. Just cried. Okay, bye-bye.